Good afternoon, everyone. Welcome to PPP Round 2, Who, What, and When. Thank you for joining us. Before we get started, we would like to review a few housekeeping items. My name is Jennifer Novotny, and I will be your technical host for today. If you have any questions or challenges throughout the session, please send a message using the chat feature in your WebEx window and send your message to the host only. Please submit questions through the chat feature in WebEx to the panelist. We will try and answer as many questions as possible and follow up after the program for any we do not get to. This session is eligible for CPE. In order to earn CPE credit today, you will need to be on the session for at least 15 minutes, and you must answer 3 out of 4 polling questions during the session to receive full credit. The polling questions will appear on the right-hand side of your WebEx panel throughout the session. You will have 3 minutes to select your answer once the poll is opened. Please be sure you hit submit once you have answered the question. At the conclusion of the program, please take a moment to evaluate the session, as your feedback is very important to us. A survey will appear when you leave the WebEx session. CPE certificates will be sent next week to the email address you provided in the registration process. We are recording today's session, and the recording, along with a copy of the materials, will be available on the Cohen & Company website tomorrow morning. Please note, CPE credit is not available for watching the replay. CPE will only be awarded for those attending the live presentation. I would now like to turn it over to Adam Hill.
Thanks, Jennifer. Good afternoon, everybody. So today we're going to get into PPP Round 2. Who, what, and when, and it's happening very fast. So they just announced before we got on that it'll be open to all banks, all eligible banks next Tuesday. So certain ones are up and running already, and we'll get into that in a moment. This is our agenda today. We're going to kind of give an overview of the stimulus related to PPP and the guidance that's come out through the SBA. And we'll jump into discussing what this second draw, eligibility, loan terms, discuss some tweaks to the first draw, and an opportunity for some new organizations and some existing to get additional proceeds from the first draw loans. Give you an update on forgiveness, and then talk about how it interacts with other credits that were in either the CARES Act or the Consolidated Appropriations Act. Okay, it's myself and Dave Sobich today. I'm going to kick it off. We will talk about the timeline. So, CARES Act was passed into law March 27, 2020. Many of you on the call today were probably on the call. I think it was right around this time on March 27th. Things are a little different today since we're all getting a little more used to wearing masks and dealing with working at home. But, you know, we are where we are. There's still COVID-19 is out there. The first round of the vaccine is out and getting administered. And hopefully this time next year, we won't have to worry about any of this. From a timeline standpoint, though, the CARES Act kind of kicked off this program, and it was up and running, you know, that next week. And from there, I don't think I've slept. So, you know, this program, the SBA, they've given additional rules on probably a weekly basis. They like to drop them about somewhere between 5 and 10 p.m. on a Friday to ruin, you know, anybody's weekend that's actually paying attention. What happened a few weeks ago on December 27th, the second round of PPP got created by the President Trump signing into law the Consolidated Appropriations Act. And then they had 10 days from there to move forward, get guidance out, and get this loan program kicking again. They did that on January 6th, which was the 10th day, about 11 o'clock at night. They dropped 125 pages of guidance in 2 interim final rules. The first interim final rule was basically the 25 IFRs that they issued throughout the year, consolidated into an 82-page document that's very easy to read. So that should help anybody that's new to the program finding most of the information in one spot. And then the second IFR was specifically related to the second draw loans that was created under this Consolidated Appropriations Act. You may hear out in the public, see articles, the title of this act, the full act was the Consolidated Appropriations Act, but it's also known and can be cited as the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. So that's Title 3 in that section is what dealt with the PPP program, and so there's a few different names out there you might hear. Wanted to make sure you understood that. Okay, and then Monday of this week, they started the loan first draw program with community financial institutions. On Wednesday, they opened it up for the second draw program with the same group. Tomorrow, they're going to be opening it up to all eligible lenders with less than $1 billion in assets. And then on Tuesday of next week, this will go live for all eligible banks, assuming those banks are ready. With the banks that we have been talking to, it sounds like a lot of them got training on this updated second draw program this past week. So it does sound like most of the banks are going to be ready to go live next week when this opens up to all. Okay, next slide. Just kind of a general overview of what affected this program. So there's it reopened up the first draw loan. So the original program, there was a lot of miscommunication, misinformation that was out there that made certain people either miscalculate their payroll and their maximum loan amount, or just made them decide to give all of the money back prior to a certain date in May. So we'll talk about that in a little bit. And then it opened up this second draw loan program, which is going to be fully live on Tuesday of next week. And that is going to give everybody that got a first loan the ability to get up to an additional $2 million, depending on their facts and circumstances and payroll. The forms have come out this week as well, so it'll be on form. They've updated form, so the 2483 is for the first draw and form 2483 SD for the second draw. The program is open through March 31st. I wouldn't be surprised if this next stimulus bill that passes might push that out a little bit from a time standpoint, but March 31st is the rules we're dealing with today. There is a polling question up as well. Okay. PPP second draw loan eligibility. So Dave Sobachan, a tax partner in our Cleveland office, is going to be jumping into this section.
Yeah, so let's talk about the borrower eligibility. You must have been in operation on February 15th, 2020. You must have received a first draw PPP loan and have used or plan to use all the proceeds on qualifying expenses before the second draw disbursement. This includes any increase now available under the existing PPP loans. Under this provision, I've heard a lot of clients at least ask the question, do I need to have my PPP first draw loan forgiven? The answer is no. You just needed to have used the first draw loan proceeds prior to the disbursement. So that's been a common question since this came out. Also must not employ more than 300 employees. And this is at the time of the application and disbursement. There's you also have to be mindful of the affiliation rules, which I'll go over in a second. And you must have had a reduction of gross receipts of at least 25% in any quarter of 2020 relative to the same quarter of 2019, or you can look at it over an annual basis as well. From the affiliation standpoint, we posted a blog. I think the name of it was How to Determine If You're a Small Business for PPP purposes. We get in a lot more details about the affiliation rules, but the things you have to look at is really 4 key areas. 1, affiliation based upon ownership. So if you've got, if an entity or individual owns or has the power to control more than 50% of the voting equity, you could have an ownership-based affiliation. And what that really means is you would just have to combine those 2 entities for the purposes of determining not only the gross receipts test, but also the employee count test. 2, affiliation arising under stock options, convertible securities, and agreements to merge. So this is a situation where you have to account for the fact that if you do have stock options, convertible securities, or an agreement to merge, if you have a document in order that would bind that ownership, you have to take that into account in determining your overall ownership for the purposes of determining affiliation. Affiliation based upon management. So if you've got a CEO or president that manages multiple entities, you could have an affiliation based upon management. And then an affiliation based upon something called identity of interest. And this is where, close relatives with identical or substantially identical business economic interests own multiple entities. You could actually have to combine those 2 entities as well. Next slide. So borrower eligibility. Business concerns, independent contractors, eligible self-employed individuals, sole proprietorships, nonprofit organizations eligible for a first draw PPP loan, veterans organizations, tribal business concerns, small agricultural cooperatives. So those are the ones that were eligible for the first draw loans. The ones we've asterisked here are the new borrowers that are eligible, which would include housing cooperatives, eligible 501c6 organizations, destination marketing organizations, and eligible news organizations. Ineligible borrowers, so those are going to include basically all of the borrowers that were ineligible for the first draw loans, which would include any business that is engaged in an activity that's either federally, state, or locally illegal, a household employer, 20% or more owner who's currently incarcerated, someone with a delinquent SBA loan, or an entity that's under investigation by the SBA or bank related to eligibility of the first draw loan program. So I'm not going to go through all of the line items here. The slides here just for your reference.
Hey, Dave, so just to reiterate, if we didn't say it yet, you had to be in operation as of February 15th, 2020. And not permanently closed. So that was those last 3 on the right are the publicly traded companies. They permanently excluded them from this line or this second draw, and they issued an IFR on it during the year, and there was a lot of front page headlines about that. So no publicly traded companies as well.
So businesses with more than one physical location. One of the things that was nice about how the second draw loan program was written is, and Adam and I can attest, the early language that we saw, we didn't see this waiver of affiliation rules, which would have dramatically impacted companies that had the affiliation rules waived in the first draw loan program, which were the NAICS code beginning with 72. Luckily enough, the language that came out after some pushing from Congress actually did include the waiver of the affiliation rule. And ultimately what that means is that you don't have to affiliate multiple companies with that NAICS 72 code, which are generally restaurants and hospitality and bars and hotels. And then there's also a special rule that says that if a single business entity with that specific code receives a second draw loan or is eligible to receive a second draw loan if it employs no more than 300 employees per physical location. So there's a physical location relief as well. And once again, you must also have to meet the revenue reduction and other eligibility requirements as well. What was added in the second draw loan program was an affiliation waiver rule as well for certain news organizations. If a majority owned or controlled by a business concern that was assigned a NAICS code beginning with 511110 or 5151. Next slide. So this is the area we've gotten, I think, the most questioned on, just because I think the language in the law is pretty basic, but then you get into specific client situations. But once again, you've got to have a reduction of gross receipts in order to be eligible for the second draw loan program by at least 25% in any quarter of 2020 relative to the same quarter in 2019. As I said earlier, you could also use an annual receipts test. So you'd be looking at 2020 annually versus 2019 to calculate that 25% reduction. You have to use your tax returns as support, for that annual test as well. There's also alternative calculations available for entities that started in 2019 and 2020 through February 15th of 2020. So, the alternative tests are those for those that are not in business in the first and second quarters of 2019. And basically, you're just using the existing quarters, third and fourth quarter of 19 to compare to 2020 as well. Let's say you started in fourth quarter of 2019, you can use fourth quarter to compare any quarter of 2020. And then if you started in 2020 through February 15th, you can compare first, second, third, or fourth quarters of 2020 for that reduction. So gross receipts are really defined as any and all income. There's specific carve-outs that we'll go over shortly, but this is normally going to agree to your tax return using what would be defined as gross receipts for tax purposes. One of the major questions we've gotten regarding this specific test is whether, if you're a cash basis taxpayer, do you use accrual basis for this calculation, or do you use cash basis? Our interpretation is you use cash basis because the support that you would be giving for the purposes of the 25% reduction test is your tax return on an annual basis. So it would just make sense that you would ultimately be able to use the cash method if you're a cash method taxpayer. For an eligible nonprofit organization, veterans organization, an eligible nonprofit news organization, eligible 501c3 organizations, or eligible destination marketing organization, gross receipts has the meaning in section 6033 of the code. That's actually defined, and it's pretty lavish definition under the regs under 6033, but it means gross amount received by the organization during its annual accounting period from all sources without reduction for any cost or expense, including, for example, cost of goods sold, cost of operations, or expenses of earning, raising, or collecting such amounts. Thus, such gross receipts includes, but is not limited to, the gross amount received as contributions, gifts, grants, and similar amounts without reduction for the expense of raising and collecting such amounts. B, the gross amount received as dues or assessments from members or affiliated organizations without reduction for expenses attributable to the receipt of such amounts. And C, gross sales or receipts from business activities, including business activities unrelated to the purpose for which the organization received an exemption, the net income or loss from which may be required to be reported on the 990T. And then D, the gross amount received from the sale of assets without the reduction from the cost or basis and expenses of the sale. And E, gross amount received as investment income, such as interest, dividends, rents, and royalties.
Yeah, so Dave, I got a few comments here. So, that was a long definition, but at the end of the day, it's essentially all gross receipts. Your investment income all the way to your donations on the nonprofit side, and then everything you're picking up on a gross standpoint on your tax return. So. The timing issue that I talk about with using the comparative year versus quarter is that you're going to need to with the application, give a copy of your tax return for 2020. So if your loan amount is calculated greater than $150,000, most likely your tax return is not going to be done anytime soon for 2020. And that's going to cause you either to delay your application or force you to go into the quarterly calculation.
Yeah, to clarify, the tax return requirement is only required if you're using this annual comparison period versus the quarterly comparison period. So this is just a depiction of, what's constituted as gross receipts. I think, spend more time really on what it doesn't include, such as net capital gains or losses. This next section is a little wordy. So taxes collected for and remitted to a taxing authority if including gross or total income, such as sales or other taxes collected from customers and excluding taxes levied on the concern or its employees, proceeds from transactions between a business and its domestic or foreign affiliates, amounts collected for another by a travel agent, real estate agent, advertising agent, conference management, service provider, freight forwarder, or customs broker. Partly that's listed there because you're acting as an agent of someone else and aren't really collecting the gross receipts. You're getting a net fee from there. And then the big one, any forgiveness amount of a first draw PPP loan that a borrower received in calendar year 2020. All these items are not included in the definition of gross receipts. For Ohio, we've received a lot of questions about what about these BWC dividends? From our perspective, I think, and there's a poll question up that just came up as well, just so everyone can click it. From our perspective, you look first, is it taxable or not? And if it's taxable, it's included in gross receipts unless it's specifically excluded. I would say, obviously with the BWC dividend, that would be taxable, so it should be included. The SBA loan payments under Section 1112, which was under the original CARES Act and then extended under the Appropriations Act, those were defined under the Appropriations Act as being not taxable, just like the PPP loan forgiveness. So those would likely not be included in gross receipts as well. So that would be the measurement point of determining whether or not something would be included or excluded. Next slide. So as we mentioned before, the documentation required for your revenue reduction, so loans with a principal amount greater than $150,000, you're going to need to submit documentation adequate to establish the applicant experienced that 25% reduction. That could include tax forms, quarterly financial statements, or bank statements. Loans with a principal amount under $150,000 or less, documentation is not required at the time of application, but it is required at the time you're submitting for your loan forgiveness or upon SBA request. So second draw loan terms, it's a 5-year term, 1% interest rate. The maximum loan size is going to be dependent upon what industry code you're in, but for everyone outside of the NAICS codes beginning with 72, it's 2.5 times the borrower's average monthly payroll costs, the lesser of that, or $2 million. And for borrowers that are in the NAICS code beginning with 72, it's 3.5 times the borrower's average monthly payroll costs, or $2 million. The other thing I noted is that remember the affiliation rules are waived. So if you're in a situation where you're in a NAICS code 72 and you have multiple locations, you'd have a $2 million restriction per location. Our belief is still that, though, that in total, you would likely be limited to $4 million in total, and that's because of the next provision, which basically is limiting businesses that are a part of a single corporate group shall no event receive more than $4 million of a second draw PPP loans in the aggregate.
Hey, Dave, I think one thing worth noting here is that you're only eligible for a second draw if you've taken a first draw loan. So we're going to be talking about going back and filing for a first draw loan if you're a first-time borrower in this program in a few slides from now. But I want to point that out because an eligible borrower that's now able to go get a first draw loan, you can choose between an 8 and 24 week covered period, and you have to spend all your proceeds prior to going to get your second draw. Right. So this March 31st deadline that's on here is pretty troubling, especially since it's taken by the time that it's available to all for the applications to be submitted would be January 19th. And, and your covered period starts on the date that you get the money distributed to you. So at a minimum, it has to be 8 weeks. So you're going to be, really close to the end of March, where March 31st is your final date to apply for that second draw. So that's why I said in the beginning that there's probably a decent probability in this next stimulus bill they might push that back some. But right now it's the date that we're living with, and if you are in that first draw bucket, you should definitely react as soon as possible to try to get available for the second draw.
So calculating your average monthly payroll costs, so this definition hasn't changed from the original program, but a number of items have been clarified through the FAQs or IFRs. The time periods you can use to calculate your average monthly payroll costs are either the 1-year period before the date on which the loan is made, calendar year 2019, or calendar year 2020. For seasonal businesses, first off, you have to meet the definition of a seasonal business, which is a company that does not operate for more than 7 months in a calendar year. and have earned no more than 33% of their revenue in any 6 months of that year. And those seasonal business can use any 12-week period between February 15th, 2019 and February 15th, 2020 for calculating the average monthly payroll costs. And there are alternative calculations for self-employed individuals, partnerships, farmers and ranchers, and new businesses.
Yeah, I think, the alternative calculation for partnerships really includes, there was a lot of miscommunication, no guidance available on the first round, and they came back and said that you should have included your partners, subject to $100,000 in self-employment income as on the original application. So that's the tweaked calculation for partnerships, and then the self-employed have some different calculations. Farmers and ranchers are allowed to use gross revenue on Schedule F versus versus payroll. So that option is available as well. And then the new businesses is based on timing. So a lot more detail that we didn't want to get into in this hour, but the information's out there, and if you have questions, feel free to reach out after.
So this slide is basically the exact same slide that we had way back in March with included versus excluded payroll costs. The one big change, as Adam mentioned before, is just the guaranteed payments for partners. There was no guidance when partnerships were applying way back in March. That guidance came out sometime in April, and and it basically clarified that they didn't want individual partners applying because that would have been a very voluminous process for the bank. So they wanted the guaranteed payments to be included as almost like a payroll cost by the business, the partnership that is the business, and them not applying themselves. It's still capped at $100,000 annually, just like any other wage. Next slide. So in terms of documentation, very similar to the first draw program. So you've got to include your 941s, your state quarterly wage, unemployment insurance, tax reporting forms for each quarter in 19 or 20, or equivalent payroll processor records, evidence of any retirement and employee group health, life, disability, vision, and dental insurance contributions. And partnerships must include its IRS Form 1065-K1s for proof of the guaranteed payments piece. And the one thing to note, there's no additional documentation to substantiate payroll costs if the applicant's using the calendar year 2019 figure to document its first and second draw PPP loan amount. The theory behind that is that the bank already has it if you're using the same lender. And that's the point, second point there, that the lender for the applicant's second draw PPP loan is the same as the lender made for the applicant's first draw PPP loan. Now, we put an asterisk here. We're not sure, SBA gives lenders the ability to determine what documentation that they need at the lender level, so they may actually request additional documentation, even if you meet these two tests. But I think I would hope the vast majority would just follow SBA guidance on this.
Okay, PPP first draw loan, first time borrowers. So you may apply for PPP loan under the original program. All of those rules essentially exist, and for draw two, the second draw, you're using the same set of rules unless they told you otherwise. So a lot of those rules that Dave just went over are different from the original program. So for those of you on the phone on this webinar today that haven't applied for a PPP loan yet, you're going to fall under those first set of rules. So, it's 500 employees, not 300, or your SBA alternative size standard. Your expanded eligibility, the new entities that Dave talked about that were eligible for the program, housing cooperatives, 501c6 organizations, destination marketing organizations are going to be limited to 300 employees. The eligible news organizations are 500 employees, and as Dave mentioned earlier, that's per site. Or per location, if you're under that 5.1 NAICS code. Okay, so I think I got the terms on the next slide here. Increased PPP first draw loan eligibility. So what's interesting here is not only did they make it eligible for those new organizations we talked about, but they did say that if you were one of the people that went and took out a loan and then got freaked out by the threat of, litigation and you didn't need it, and you gave it back, that you can go back to your original lender and request for that loan to be issued again. As well as if you were a partnership, LLC, that filed within the first week, they didn't have the guidance out by that point to really, allow for the general partners or the partners of the partnership to include their self-employment income on those applications. So, there was a period of time that they allowed it for if your loan, if the bank didn't file the form they needed to file yet. So I didn't see a lot of clients go back and recalculate and were successful with the bank being able to increase their proceeds in the first round program. So this is the second bite at the apple for those issues, as long as you have not received forgiveness. So, that's the catch. So if you have filed for forgiveness, you're going to be excluded from going back to your bank. So guidance should be issued today, I think. The 6th was 10 days from the date of enactment. Today, I think, is 17 days. There's another polling question up as well. So where I was going with that is by the end of today, we should have additional guidance on how to apply for these additional draws or redraw if you gave the entire thing back. It did seem like the banks have the option to allow this, not necessarily would be forced. So it'll be interesting to see, what happens here. But I'm sure there's a lot of specific questions in this area. So if you get caught up and you're not getting anywhere with your bank, feel free to give us a call. What else? We're still at 500 employees. You had to be in, around in operation at February 15th, 2020. All the other rules still apply. All right, let's move on to forgiveness update. So full forgiveness is available for both first and second draw loans. This 60-40 allocation stayed the same with this act. So all of that is identical from loan one versus the second draw. What they did do though is if you any new first draw loan can also use the eligible expenses they opened up for the second draw loan. So, I think we talked about those oh, no, the next slide. So I'll get into those in a minute, and the additional options you have to spend the 40% portion, right, of your income. The important thing here is you still need to spend 60% on payroll. And, this program is really grounded with the fact that you're keeping your employees employed. All of the rules around FTEs are there. Your certifications that you're making on the application is, you're saying that you're going to all loan proceeds will be used for business-related purposes, and to keep your current your current employees on and not have salary reductions. So the rules on the forgiveness side, we did a webinar on that in October. Those all still apply. So we want to make sure that on the back end of this, you get it fully forgiven. So you want to make sure you comply with the rules that are out there. Okay, covered period. I discussed this earlier, but just want to reiterate. So the alternative covered period no longer exists. And because of that, and for those of you that weren't borrowers in this program before, they allowed you to move from the date of disbursement to like your next payroll date to have this alternative covered period for payroll only. Related to the timing. They scrapped that and they just said, we're going to let the borrower choose. So your covered period starts on the date that you receive the disbursement, and then you have the ability to pick whatever day you want between 8 weeks and 24 weeks. That you can basically make it line up with your payroll. All the rules about items paid or incurred during the covered period still exist, so you can pay unpaid rent that you haven't been able to afford because you were waiting for this money, and then you can pay your rent that you incurred during the covered period. Same with utilities. A big item that we didn't talk much about here because I would imagine everybody has heard this through, anywhere they were paying attention to the news or our client service teams. The forgiveness is not taxable and the expenses are not deductible. So that was a big fight. A big problem at the end of the year where this act fixed that. A huge benefit to not, suck away 40% of the impact here going back in taxes. So, the exact language in there says no deduction shall be denied, no tax attribute shall be reduced. So, even with S corps, there shouldn't be, a basis issue related to the fact that you have this tax exempt income and your ability to expense all of those deductions. Dave, did you have any comments there? No. Okay. We'll go to the next slide here. So the additional eligible non-payroll costs, you have covered operation expenditures. So this is going to allow you to pay for software, cloud computing, other human resources and accounting needs that you needed to take on because you weren't in the office or your employees were scattered throughout their houses. Covered property damage costs. So this one specifically relates to any damage due to public disturbances throughout 2020 that are not covered by insurance. So if you were reimbursed by insurance, you wouldn't qualify here. But if you did have a downtown urban setting and you had substantial damage to your business, you could include those to the extent that they weren't covered. Covered supplier costs. So these costs are expenditures to a supplier, pursuant to a contract, purchase order, or other order for goods in effect prior to taking out the loan that are essential to the recipient's operations at the time at which the expenditure was made. So I think, this includes perishable goods, and can be made before or during the life of the loan. So I think this area, this definition is very broad, and you shouldn't have a problem hitting that 40% threshold, but you just need to remember that payroll needs to be at least 60% of the use of these funds. And then covered worker protection expenditures. So, all of the face guards and masks and everything else that you had to do to implement within your business, all of those expenses would be eligible as well. Okay, there's simplified forgiveness period. So this one, I think they had 21 days to come out with some additional guidance. Yeah, there it is. January 21st. By then they should have something up and ready that's essentially a one-page, certification for all loans under 150,000. And they're in the act that the prior version of this, before it finally got passed, they did have a simplified approach to loans under $2 million as well, but that got scrapped in the final bill. So if you did hear anything about having a simplified forgiveness process for loans between $150,000 and $2 million, that is not going to be the case. And so under 150,000, the SBA said the original CARES Act said 6 years. The new, retention policy for loans under 150 are 4 years, and 3 years for the other records. We're going to keep moving here. We got about 10 minutes left. Dave, so this employee retention credit, we didn't want to get into everything in the Act and all the tax extenders, but this one in particular, as it relates to PPP, is something everybody on this call should be paying attention to, because the original terms of this credit were that if you received a PPP loan, you weren't eligible for the employee retention credit. The Act that just got passed it basically appealed that provision. So you are able to get a PPP loan and qualify for the employee retention credit, but you can't use the same wages for both. So this credit here is limited to $10,000 per employee for 2020 of wages, eligible wages, and the credit is 50% of that. So it's $5,000 per employee. You have to be under 500 full-time employees in 2019, and so if you're under the 500 employees, you also need to have a substantial reduction of gross receipts, 50% or more, or have your operations fully suspended by government order or partially suspended by government order. And I broke those two out because the partially suspended by government order in the FAQs and the additional guidance they came out with, that's by limiting commerce, travel, or group meetings due to COVID-19, such that the employer can still continue some, but not all of its typical operations. So that's probably a lot broader of a category there, and I think there's opportunity for people to look back into 2020.
Yeah, Adam, the one very important point on that slide is if you were under 100 employees, 100 full-time equivalents, even if you were, let's just say, working remotely, and you met one of the other tests, you still have the ability to potentially file for a refund claim. But if you're over 100 employees, and your employees could be still working remotely, you weren't eligible for that refund claim. You had to effectively, for businesses with more than 100 full-time equivalents, you had to be paying your people to basically just be non-productive during that time. So that's a key distinction. So what we're recommending, and this is why we're not going to get into a dramatic amount of detail here, is each client situation is going to be unique. Contact your Cohen & Company service team so that we can determine whether or not you have the ability for a refund claim, because this change about the PPP and employee retention tax credit provision is a retroactive change. So you could potentially get a refund claim for 2020.
Yeah, so I think especially if you're under the 100 employees, there's a huge opportunity here to get some sort of refund. So the updated credit, right? They remove the provision retroactively, as Dave just said. The borrower, there's no double dipping, right? And that goes across all government programs and all tax credits. So there's some other credits that are out there that were available in some other stimulus that passed. Was the paid sick leave credit and another credit for taking care of COVID-19 family members. Those credits also can't. You can't use the same wages for all of these. The other part that was updated with this current act is it was extended through June 30th, and the $10,000 limit was quarterly versus annually, which means that the credit that was 50% increased to 70%. That means that you could potentially be eligible for $14,000 per employee through this period of June 30th, 2021. But if you get a PPP loan, you need to remove those wages first before calculating this credit. I just wanted to briefly touch on this because we do have certain clients in this industry. There's a shuttered venue operator grant program that is part of this act as well. The big point here is if you decide to go down that route, there's $15 billion set aside for this program. You cannot receive a first draw or second draw PPP loan starting with the date of enactment. So if you're in that category and you received an original PPP loan, you would be okay because you just can't receive them after December 27, 2020. It's a credit awarded on need. It's 2 14-day periods that allow for those most hurt. I think it's 90% of reduced revenue first, and then 70% in the second period. And it's a calculation based grant based on total revenue in 2019. So that's out there. Wanted to make everybody aware of it. If you fall into these rules, and it's not just the venue itself, but it's all the people that are involved in that venue, so the promoters and the talent representatives and those as well. Last thing here, I think we've tried to answer most questions, or we tried to answer most questions while we were talking as we saw them coming in, but there is a lot of people on the phone today or on the webinar, so there's a substantial amount of questions. I think we're up to 350 questions. So we will try to get back to you or someone from your service team in the next day or two. One last thing I wanted to mention here is that if the first round, a lot of our clients had trouble getting to their bank or finding a bank that would let them sign up and apply for this credit. The last polling question is up as well. So AICPA, through its affiliate CPA.com, has partnered with a fintech provider, Biz to Credit, that rolled out a tool for CPA firms to support their clients through an application portal, application funding and forgiveness process. So we have signed up for that. It is an option if you're having trouble going through your bank. If you're going for a second draw and you're going to go back to your original bank, that's probably the easiest route. But this is available to just help our clients out that are stuck, because there were just so many of them back in April. And so this portal, it goes from creating the application, so your service team or the team that we put together here, if you needed it, could go through that application process. In fact, we could help anybody with the process of the application, but what's different and unique about this loan portal is it'll actually go, we would submit it to the bank after basically the CEO. All they have to do is review the filled in application and e-sign it, and then it would go to the bank. The bank would have a few questions, and then it would be off to the SBA. They created this because of all the issues, and this is a service that we're able to provide if needed. So keep that in mind. And with that, Dave, I think we should. Do you have any closing comments before?
Just reiterating, obviously, with the employee retention tax credit, that's an opportunity to create cash for your business. So reach out to your Cohen & Company team to see if there's a refund opportunity there. And then I would just say, considering the start date for PPP2, the second draw loan program, I would start communicating with the bank if they haven't already started reaching out to you. I have heard a number of lenders have started to reach out to borrowers, but I would try to keep that line of communication open, primarily because if your bank isn't ready to stand this up when this starts up, you may want to consider an alternative method like, the CPA business loan portal, because we're obviously not sure how quickly the appropriations are going to get run through.
So I think the last comments that I have, and we'll let everybody go since we just hit the 1 o'clock hour, but there, hopefully not as many IFRs will be coming out, but there will be some additional guidance coming out, probably a lot more frequently asked questions to help with the process. I do think they did a much better job, rolling it out and answering a lot of questions this time. So that is out there. And as a reminder, this is first come, first serve. Out of the $284 billion that's allocated to the program, there's a lot of underlying carve-outs for, $25 billion for small lenders and $25 billion for less than 10 employees that have loans under $250,000. So they're really trying to get this money out to the masses, and hopefully get it out to anybody that missed out on it the first time, that's had significant economic impact based on the pandemic. With that, I think we're going to wrap it up and thank everybody for coming. And Jennifer, do you have anything else?
Actually, just want to thank everyone again for their time today. And then as a reminder, we'll post the presentation and a video replay to the Cohen & Company website, probably be up either later this afternoon or first thing tomorrow morning. Thank you, everybody.
Great. Thank you. Take care.